you're actually paying far more tax on your monthly pay than your payslip leads you to believe. You thought it was 20%, right? Well, the government lets you think that, but the truth about the amount you tax goes far deeper, and some might consider far darker than most people realise. So today I'm going to unveil the truth about all the different ways you're actually taxed on your income, including death tax interest. And so that this doesn't end up being the most depressing video on YouTube, I'm going to make sure to include a few little tips and tricks to help you to not get totally rinsed by HMRC. We release weekly no-fluff guides for small businesses, UK directors, and anyone looking to start their own business. So if you'd rather understand tax than fear it, hit subscribe. If it's not for you, you can unsubscribe with just one click. So let's start with the most shocking one that's hidden right under your noses: income tax and national insurance, the stealth tax that doesn't get nearly enough hate. Recently, HMRC has raised the minimum wage, which sounds generous on the surface, right? Yay, more money for workers. Except it's not generosity, it's a stealth tax grab in disguise. And here's what's actually happening. From April 2025, the national living wage rises to £11.44 per hour. For a full-time worker on 37.5 hours a week, that's just over £22,300 a year. But the personal allowance, the bit of your income that's tax-free, hasn't budged from £12,570 since 2021. Nor has the threshold for higher rate tax moved, the £50,270. All frozen, solid as a rock, less movement than Simon Cowell's face. So, what does that mean? More people are now earning above the tax-free allowance and being pulled into tax bands they were never in before. In real terms, that means someone getting a pay rise might actually end up with less take-home pay once you factor in income tax and national insurance. It's called fiscal drag, a lovely, polite economic term for the government slowly dragging more of your income into their coffers without raising taxes. It's inflation's quiet accomplice, and it's one of the most effective tax hikes in history, precisely because hardly anybody notices it. Here's a basic example. In 2020, someone earning £17,026 paid very little tax, around £1,800 for the year, and that's including NICs. In 2025, that same person could now be earning £25,396 thanks to national minimum wage increases, but now they pay income tax on everything over £12,570. They pay national insurance on earnings over £12,570, and their employer pays NIC too on anything over £5,000, further reducing how much they can be paid before it hurts the business. So they're already paying around £3,500 as an employee on that income. Although £21,800 might seem like a good amount of take-home pay, with the cost of living only rising, it's comparable to taking home £15,113 back in 2020. There's a difference. So in reality, the government gives with one hand and then takes with two. Now, imagine this scaled across millions of workers, billions more in tax revenue, without ever having a vote on a rate change. As a small business, you're affected in either what you can earn before paying tax and NI on your salary as a director of a limited, or as a sole trader through your tax and NI on your self-assessment. If you've got employees, then the actual wages needed for them to cover the household costs is more than any minimum wage increase, making it really expensive to have the help that you need to be able to grow your business. Now, let's take a moment to appreciate fuel duty, a tax that's so baked into everyday life, most people don't even realise they're paying it. Spoiler alert, you are, a lot. Fuel duty currently stands at 52.95 pence per litre for petrol and diesel. And that means that for every litre you put in your car, the government takes over 50 pence before they even think about that. Let's break that down. You buy 1 litre of petrol for, say, £1.50, 52.95p of that is fuel duty. 52.95p. Then the government slaps on 20% VAT, and that's not just on the fuel itself, but on the fuel duty too. Yeah, that's right, you're paying tax on a tax. It's like buying a meal and being charged back on the tip, or paying stamp duty on your council tax. It's totally absurd, but it's completely legal. If you fill up a 50-litre tank, you're paying about £26.50 in fuel duty alone, then another £12.50 in VAT roughly. So over £39 of your £75 fill-up goes straight to HMRC. That's 52% of the cost, over half the tank. That isn't fuel, it's tax. And if you're a business owner using your car for work, you can claim 45p per mile for the first 10,000 miles under the mileage allowance, sure. But that barely scratches the surface if you're covering long distances, you're dealing with price hikes, and you're still being hammered at the pump every week. If you take the average person on an average salary in the UK of 35k, they'll pay tax and NI on that already of about £6,200 a year. Let's say they fill up twice a month at a moderate £75 per time. So an average of £150 per month on fuel, getting to work, ferrying the kids around. We'll call that the F amount. Not least as that's how you feel when you realise how much tax you've paid on it. So that's a further £3,328 per year in taxes paid on the F amount in fuel duty and VAT. So far, HMRC has had £9,528 out of them in taxes. So why does this matter? Because fuel duty disproportionately affects lower income households and rural workers, people who have to drive for work or even for family, and they don't have access to reliable public transport. And they'll be spending a lot more than £150 per month on fuel. For couriers, mobile tradespeople, or anyone whose business involves being on the road, fuel isn't just a cost, it's an essential utility, yet it's taxed more heavily than luxury flights or caviar. And while the government likes to freeze fuel duty for a few years and call it support, they don't reduce it, they just hold it steady while the prices go up. And in fact, fuel duty raised £24.3 billion for the Treasury in 2023. That's more than inheritance tax, alcohol duty and tobacco duty combined. And where does it go? Not into fixing the roads, judging by the state of most of them. Unless, of course, potholes are now considered traffic calming measures. Speaking of vehicles, if you thought going electric would save you from the tax man, think again. As of the 1st of April 2025, the UK government has pulled the plug on the Vehicle Excise Duty (VED) exemption for electric vehicles, EVs. That's right, EVs are now subject to the same annual road tax as petrol and diesel cars. Here's how it breaks down. New zero-emission cars registered on or after the 1st of April 2025 will have a first-year rate of £10. Subsequent years will be £195 annually. Zero-emission cars registered between the 1st of April 2017 and the 31st of March 2025, their annual rate is £195 from April 2025 onwards. And zero-emission cars registered between 1st of March 2001 and 31st of March 2017 have an annual rate of £20. But wait, there's more. If your shiny new EV has a list price over £40,000, you'll also be hit with the expensive car supplement, an additional £425 per year for 5 years, starting from the second year of registration. Ridiculous. So let's say you buy a new electric SUV priced at $45,000. The first year, £10. Not too bad. Years 2 to 6, it's £195 plus $425, $620 annually. The total over 6 years, £10 plus the 5 times 620 is £3,110. That's a hefty sum for a vehicle that was previously exempt from road tax. And it doesn't stop there. Hybrid and alternatively fueled vehicles, AFVs, have also lost their £10 annual discounted amount. They now pay the same standard VAD rates as their petrol and diesel counterparts, depending on the CO2 emissions and the registration date. This shift is part of the government's plan to ensure all drivers begin to pay a fairer tax contribution. Their words, not mine. But critics argue it could deter consumers from switching to cleaner vehicles, especially amid rising energy costs and limited charging infrastructure. So while the move aims to level the playing field, it might just make the road to greener motoring a bit bumpier and pricier. Next up, let's talk about that beloved monthly reminder that you're not actually allowed to live in your own house without paying the local council for the privilege, council tax. And whilst refusing to pay your council tax isn't a criminal act, it's classed as a civil debt. You can still be imprisoned as a last resort for failing to pay the debt, but not for refusing to pay. Like, that makes sense. For most people, this isn't just a side cost, it's a major monthly bill. The average Band C property in England now pays £1,812 per year. That's £151 per month. Just for the joy of having your bins collected every other week, except if you live in Birmingham, and the occasional resurfacing of the same stretch of road, which promptly disintegrates after just one frost. And here's where it gets really cheeky. Council tax is still based on property valuations from 1991. Let that sink in a moment. 1991. That's back when petrol was 40p a litre, East 17 were in the charts, and Windows 3.1 was considered cutting edge. And these magnificent cultural references are meant to serve as a jarring reminder that 1991 was actually a bloody long time ago. So, if your property has doubled or even tripled in value since then, which, let's face it, most have, it doesn't matter. You're still lumped into the same band it was assigned over 30 years ago, unless you formally appeal or are moved during a council review. Meanwhile, two nearly identical houses on the same street can be paying wildly different amounts just because one had a loft conversion before 1991 and the other didn't. And who does it hit hardest? Yep, lower income households. Unlike income tax, council tax isn't tied to your earnings. Whether you're on $20,000 a year or $120,000 a year, your council tax is the same. So proportionately, it drains far more from people on lower incomes. That's what makes it one of the UK's most regressive taxes. That's regressive, not aggressive. And no, the single person discount doesn't make up for it. A 25% reduction on a broken system is still a broken system. However, a useful tip, you can apply for reductions if you're on a low income or claim benefits. And there are a few other reasons which give you a reason to not pay, such as full-time students if you're studying more than 21 hours per week and more than 24 weeks per year. So given that you have an income, probably have a vehicle and put fuel in it, plus you have a roof over your head, the actual taxes you're paying out of your 35k we mentioned earlier currently total about £11,500. That's almost 33% of your income. But if you thought council tax was bad, wait until you try to buy a home. Enter stamp duty land tax, SDLT. The government's way of saying, congrats on scraping together a deposit during a housing crisis. That'll be quite a few grand, please. Here's how it works in England, and it's different. There are different rules apply in Scotland and Wales. So there's nothing to pay on the first 125,000 of a residential property. There's 2% to pay on the portion from 125,001 to 250,000. Then there's 5% on the portion from 250,001 to 925,000, and 10% on the portion from 925,001 to 1.5 million, and 12% on the portion above 1.5 million. So let's say you're buying a fairly average home in the southeast for 400,000. The first 125,000 tax-free. Yay! The next 125,000 is taxed at 2%, so 2,500. And the remaining 150,000 is taxed at 5%, 7,500. That's a total of 10,000, 10 grand in SDLT just to buy a house. And that's before solicitors, surveys, or moving costs. And if it's a second home or a buy-to-let, add an extra 3% surcharge across all bands. Oh, and if you're a first-time buyer, yes, you get a relief. No tax up to 300,000 on properties up to 500,000. But cross that threshold and you're hit with the full rate, no matter how long you've been saving your 5% deposit while renting at extortionate prices. Just where you thought you'd escaped all those taxes by dying, HMRC shows up at your funeral with a clipboard and a calculator. Yes, even in death, the taxman gets paid first. We're talking about inheritance tax, one of the UK's most controversial and poorly understood taxes, and unfortunately one that more and more normal families are getting caught up in. Here's how it works. Your estate, which includes your house, savings, investments, business, car, and anything else with a value, is added up when you die. If it's worth over 325,000, everything above that is taxed at a whopping 40%, even though you've already paid tax on the income to buy those things. You're taxed again at 40%. If you're leaving your main home to your direct descendants, your kids or grandkids, you get an additional 175,000 residence nil rate band, giving you a total allowance of 500,000 tax-free. Now, for married couples, you can combine both allowances, so that's 1 million tax-free if both spouses pass everything to each other and then on to the children. Sounds okay-ish on the surface, right? But with property prices what they are, especially in the southeast, it's alarmingly easy to breach that threshold. And the really grim bit, inheritance tax is due 6 months after the end of the month you die. And if it's not paid, interest starts building. As of April 2025, the interest rate for late payments is 7%. But here's the real shocker. The estate usually has to pay the tax before your family can access the money. So your loved ones might be forced to take out a loan, use their own cash, or sell family assets quickly and often cheaply just to cover the tax bill. And that's assuming they aren't still in shock, trying to plan your funeral, sort out the paperwork, and figure out where you left your will. Top drawer, sock drawer, drop box. But on a serious note, I know how absolutely devastating this time can be. So my advice to anyone trying to deal with this is get some help. You might be the executor, but you don't have to do it all on your own. And professional help will take some of the pressure off, and it can be covered, any of those costs for help, by the estate. Even more so for anyone thinking ahead, you can plan for this with some good estate planning, even to the point that there are some insurance policies that can help cover IHT for your beneficiaries. Okay, we've covered a lot, and if your head's spinning right now, that's probably because you've just realised how much tax you pay without even noticing. But here's the good news, you can fight back. You might not be able to change the system, but with the right strategies, you can at least stop overpaying into it. So here are some practical ways to start reducing your tax bill legally, sensibly, and without needing a loophole named after you. Use your full personal allowance and your family's too. If you're running a business, make sure you're optimizing the mix of salary and dividends, using employment allowance if you qualify, and splitting income with your spouse if they're on a lower income band. Remember, they've got a $12,570 allowance too. I'd recommend watching our video, Maximise Your UK Allowance, if you want to find more ways to take advantage of this benefit. Make pension contributions through your company. Your business can contribute up to $60,000 into your pension annually, and it's a deductible expense, so you pay less corporation tax and build tax-free retirement wealth. If you're a higher rate taxpayer, this is especially powerful. Claim every allowable expense, from home working costs to mileage allowances, mobile phones, business travel, subscriptions, even directors' life insurance. If it's a genuine cost of doing business, claim it. You'd be surprised how many business owners leave thousands unclaimed every year. Even remote employees on PAYE can get tax relief for work from home. Reinvest profits or use intercompany loans. Instead of extracting your profits out and paying dividend tax, consider reinvesting in your business, making strategic hires or loaning funds to a second company, especially if you're planning investments in property, new ventures or R&D. This keeps profits within your corporate structure, tax deferred, not taxed away. Plan for inheritance early. Don't wait until you're writing a will at age 84, trying to remember the names of your grandkids. Use tools like business relief, gifting, and trust planning while you're still working. And remember, IHT planning isn't just about saving tax, it's about saving your family from stress and chaos later on. Plus, talk to someone who lives and breathes this stuff. The tax system isn't just complicated, it's intentionally complicated. So whether you're a sole trader, a limited company, or about to sell your business, don't guess, get a proper strategy. There's a link in the description to book a free discovery call with us. We'll talk through your setup, and if we can help you claw some of your hard-earned cash back from HMRC, we absolutely will. Here's the truth. The UK tax system isn't just there to raise money, it's also designed to reward people who plan ahead. If you just follow the default path, PAYE, standard bills, then you could end up paying 40%, 50%, even more of your income to the government without realising it. See you next time.